Hey traders, and welcome to Trade Like Assad. The crypto market is heating up fast. Bitcoin has broken past its all-time high, crossing $124,000, but its dominance is slipping day by day, pointing to the early signs of altcoin season. And that brings massive opportunities ahead. Most crypto traders pay attention only to fundamentals while completely overlooking technical analysis. That's a costly mistake. In this video, I'll walk you through a strong trading plan based on technicals, with clear and simple steps designed to help you nail the best possible entry points, even during a bull run. Because whether you're buying for long-term holding, trading spot, or using leverage, your entry price makes all the difference. If you find value in this video, don't forget to smash the like button, and if you're new here, make sure to subscribe and turn on the notification bell so you never miss our latest uploads. I'll see you right after the intro and disclaimer. Welcome back, traders. Let's begin with the fundamentals and understand how supply and demand zones are created. In a bullish case, whenever price pushes through a previous high, it generates an unmitigated demand zone connected to the impulse leg. On the other hand, in a bearish move, each time price breaks a significant low to the downside, it develops an unmitigated supply zone. In short, supply and demand zones are areas where price makes a strong impulsive move that causes a break of structure. Now, you might wonder, why is spotting these zones so critical? Here's the reason. These zones mark where smart money initiates positions, often right at the beginning of a trend. They act as decision points that form before institutional orders are fully placed. This is why they hold so much influence. Price usually reacts to them. When price revisits these areas, institutions often step back in to defend their earlier positions. Put simply, institutional money protects its territory, and that defense often triggers reversals. Another major reason price tends to reverse so cleanly from these levels is due to how institutions execute. Big players don't place their entire order flow all at once. They scale in progressively, often in several phases, particularly around zones where earlier trades left footprints. As a result, not all of their original orders are filled in the first impulse. So, when price comes back to the demand zone, institutions treat it as another opportunity to execute the remaining orders. That's when they intervene. This is exactly why we wait for price to retest these areas. Now, let's continue and learn how to properly draw them on the chart. Here, price is moving in a strong uptrend, forming a series of higher highs and higher lows. That tells us our focus should remain on identifying demand zones. Looking closely, you'll see price consistently breaking past previous highs while protecting the lows. Each breakout above a prior high creates a fresh demand area. Starting from the lower left, price breaks the recent high with a sharp impulse leg. This breakout establishes a demand zone at the origin of the move. To mark it correctly, you need to identify the very start of the impulse that caused the structural break. That precise point is where price was forcefully driven upward. In this scenario, the last two consecutive down close candles before the expansion represent the demand area we're targeting. Once again, price forms another higher high. After a brief pullback, it drives upward, breaking the most recent major high and confirming a bullish break of structure. That action generates another demand zone at the origin of this new bullish impulse. Here, the three consecutive down close candles before the strong expansion mark the next unmitigated demand area. Next, price establishes yet another higher high, then pulls back. Notice how it directly taps the earlier demand zone, rejects strongly, and reverses with heavy buying pressure. This aggressive rally pushes beyond the latest high, confirming a fresh break of structure. So, we now have another demand zone to identify. As before, we look at the origin of the bullish impulse leg, the exact point where price surged upward. The opposite colored down close candles at that spot form the latest demand area. Moving forward, price retraces lower. After testing the newly formed demand zone, it turns upward and rallies higher, briefly piercing the most recent swing high with a wick before closing back inside the range. This is an important sequence to analyze carefully. Since price failed to close above the prior major high, this does not qualify as a valid break of structure. Instead, it is classified as a liquidity sweep. Here's the key point. When price only sweeps liquidity above a high without closing past it, No new demand or supply zone is created because there is no confirmed structural break. What's actually happening is price is collecting liquidity above that swing high to build momentum before choosing its next direction. Therefore, the red down close candle preceding this liquidity sweep cannot be considered a valid demand zone, as the required condition, a confirmed break of structure, is absent. Now, let's move on to the next topic. Supply and demand zones are divided into three main categories: mitigated, unmitigated, and failed. A mitigated supply or demand zone is one that price has already tapped into and respected at least once. Now, here's the key detail. To decide whether a zone is mitigated or unmitigated, you must wait for a break of structure and then check if price revisited that zone after the boss. For instance, in this case, notice how price did not return to the demand after the boss. That means the zone remains unmitigated, because any mitigation that occurs before the structural break doesn't count. Another crucial point: once a supply or demand zone has been mitigated, your attention should shift toward the next zone. This often signals strong trend continuation. If that next supply or demand area is also respected, you then move forward to the following zone, step by step, aligning with the trend flow. Just like order blocks, supply and demand zones follow a one-time use principle. That means we only rely on them for trade setups or analysis when price first reacts to them. Once a supply, demand, or order block has been mitigated, it loses relevance for future trades. Unmitigated zones are those where price hasn't yet revisited after formation. These are the most critical zones to monitor, since there's a high probability that price will return to mitigate them, often sparking strong moves or reversals. The third type is failed zones. As the name suggests, these are zones that price doesn't respect. Instead, price pushes through them and closes beyond with a candle body in the opposite direction. Why do they matter? Failed supply and demand zones reveal which side holds control, where potential shifts in market structure may occur, and how to prepare for the next major move. Now, let's dive deeper into how you can leverage supply and demand zones to build a profitable trading model in the crypto market. Whether you're an active crypto trader or simply an investor, there's one principle you need to grasp. Your entry price is everything. It's the single most crucial factor that determines whether you survive in the market and whether you generate consistent profits. It doesn't matter if you're buying for long-term holding, trading spot, or even using margin with leverage, your entry price will always be the game changer. This is where supply and demand zones come into play. They work exceptionally well in the crypto market and provide high-quality opportunities, especially in highly liquid coins like Bitcoin, Ethereum, and Solana. So, let's explore the crypto-specific version of a supply and demand trading model. Suppose we're in a bullish environment with price trending upward. In that scenario, our focus remains on buying opportunities. Step 1 is to locate the most recent unmitigated demand zone on the 4-hour or 1-hour chart. Remember, in crypto, supply and demand zones on the 4-hour and 1-hour timeframes tend to hold stronger and are respected more often by price. After identifying the higher timeframe demand zone, the next step is to wait for price to revisit that zone. Once it does, we zoom into a lower timeframe such as the 5-minute or 15-minute chart, looking for early signs of reversal. This could be a market structure shift or a clear change of character. That's your first layer of confirmation. This signal indicates the temporary bearish move is ending and bullish momentum is returning. At this stage, price is expected to align again with the dominant bullish trend of the higher timeframe. Once the market structure shift is confirmed and we anticipate price moving higher, the next task is to hunt for a buying setup. At this point, we look for a bullish fair value gap, an order block, or an inverse fair value gap forming within the structure shift leg. These areas often act as magnets, where price is likely to retrace before resuming the upward move. To enter, you would typically place a buy limit order at one of these identified zones. For example, if your intention is long-term holding, this gives you an optimized entry point, allowing you to hold confidently. But if you're trading spot or margin with leverage, risk management becomes vital. In that case, place your stop loss a few pips below the swing low to protect your capital. When planning your take-profit levels, you have two solid approaches. Either target the nearest liquidity pool on the current timeframe or aim for higher timeframe key levels if you're trying to capture a bigger move. To apply this trading plan effectively, You need to use multiple time frames in order to capture the highest probability setups. Begin with a higher time frame to study overall market conditions and locate high-quality supply and demand zones, such as the 4-hour or 1-hour charts. Then, drop down to a lower time frame to zoom in for entry signals and confirmation, typically on the 15-minute or 5-minute charts. If you prefer working with the 1-hour chart to spot supply and demand, and then move down to the 5-minute for entries. You'll notice the 1-hour generates more frequent patterns compared to the 4-hour, which can be beneficial for active traders. However, keep in mind that zones formed on the 4-hour tend to be more reliable and carry higher quality. So, if you choose to use the 4-hour time frame for identifying supply and demand, then your confirmation and entry should come from the 15-minute chart instead. Now, let's bring everything together and walk through an actual trade example on a live chart. On the coin dollar 4-hour chart, you can see that the overall market structure is strongly bullish. Bitcoin is currently in the middle of a bull run. Looking closer, notice how price created a break of structure with a strong bullish momentum candle, breaking and closing above the most recent swing high. This confirms that buyers, the bulls, are in control of the market. Based on this, we should anticipate further upward movement. With that confirmation, our focus turns exclusively to spotting buying setups. Next, we shift our attention to the origin of the bullish expansion that caused the most recent break of structure. That origin point forms a demand zone. Notice I'm not marking these two down close candles here. If you examine closely, price already dipped below this red candle through the wicks of the following green candles. Since I don't consider more than 3 candles when defining supply and demand zones on the 4-hour chart, I mark the zone starting from the lowest point of the expansion leg, the true origin of the move. This leaves us with a fresh unmitigated demand zone, and this is exactly the area we want to monitor closely. It's the ideal zone to plan long positions if price retraces into it. Now, let's roll the chart forward and see the outcome. As you can see, price taps into the demand zone and instantly shows rejection. At this point, I zoom into the lower time frame, in this case, the 15-minute chart, to carefully monitor price action inside the 4-hour demand zone and refine a precise entry point for a long position. Now, looking at the 15-minute chart, you'll notice that after price tapped into the fresh 4-hour demand zone, it rejected and then created a market structure shift by breaking and closing above this 15-minute swing high. This indicates that selling pressure is weakening, buyers are stepping back in, and price is likely to realign with the 4-hour bullish trend. Once the bullish structure is confirmed on the 15-minute, we expect price to continue pushing upward. The next step is to locate an entry trigger for a long trade. This could be a fair value gap, an order block, or an inverted fair value gap that forms within the market structure shift leg. Looking closely, you can see that price has formed a bullish fair value gap within this structure shift leg. This zone often acts like a magnet, drawing price back before resuming the move to the upside. So, in this case, I place my entry at the highest point of that 15-minute bullish fair value gap using a buy limit order and simply wait for the order to be filled. If you're buying to hold as a long-term investment, your stop loss should be positioned below the 4-hour demand zone. However, if you're trading spot or margin with leverage, then your stop loss should be set just under the 15-minute swing low. Now, let's see how this trade unfolds. As you can observe, price dipped lower, triggered our buy limit order, and then reversed direction, moving higher exactly as anticipated. This perfectly demonstrates the effectiveness of combining higher timeframe demand zones with lower timeframe confirmations to achieve precise sniper entries. That's all for today, traders. Thanks for watching. I hope you gained value from this video. If you did, make sure to subscribe and enable notifications so you never miss future updates. Share your thoughts or topics you'd like us to cover next in the comments below. Your support truly means a lot to us.